Welcome to the second video of the financial markets playlist, and now I'm going to speak about the stock market. So the stock market is a part of the financial markets which is mostly related with the companies that are selling their shares, to put it that way simple. But at the same time you can take an index, which the index in the stock market, it's made of the most important, I would say, companies, like for example the New York Stock Exchange or the Nasdaq, which is mainly for the technological companies like Google, Amazon, and so on, or like for example US 30, Dow Jones, which is made more for the industrial companies put together and they make an index. However, maybe I follow myself too much, so let's start it one by one. So in a way, to put like this, the stock market allowed the acquisition of these securities of these companies that are listed on the different world financial markets. You have European one, Indian, Chinese, I don't know, American, Latin American, and so on. So all these companies, they have a stock. And a stock is the unit, I would say, of the financial participation in a company that is going to be able to be sold to the investors or traders as well. You don't just want to invest, maybe you are just a day trader, you want to buy some stocks and sell them and gain some profits. So of course, this price of these shares is going to be fluctuating, like you are going to make profit. Like for example, if you expect like the price is going to be up and you buy it initially, for example, when it's $10 and you sell it with 11 or 12, or you can also make money if you believe that the price is going to go downwards. So like you establish with another client, like you are going to sell to him to $11 and you are going to buy it with $10. So in this way you are going to still manage the same profit like you would do in the other, just using a different type of trades. So yeah, there are many technical stuffs here that I'm not going to enter too much into it, but if you are interested you can enter in my blog and see all the full details about it. And what I want to speak more about, it's about the evolution of the price, of course. Like I said previously, in the financial markets, the most important criteria that we have is the law of the supply and the demand. And like for example, if you are going to, let's take a company like it's been around, from the beginning. Let's look for example at Amazon. Like you can see, Amazon, in this case, is from Nasdaq, which, like I said, Nasdaq is for the technological companies. But yeah, and let's go for example with the big time frame. Let's go like for example weekly. You can see that it's since beginning. Initially it has some stand up. For the first 10 years, I would say, since being listed. But after that, it started to gain a massive popularity. Why is that? Because more and more people started to use it. More and more people started to depend on it. Let's take for example a look at another type of company. I would say like Google, like Alphabet. Like Alphabet. So in this case, for example, you can see the same since the beginning. It was always used over and over again. And as long as this type of demand is still going to exist, I don't believe Google is going to disappear in the next 10 years. Its price is not going to grow like this. You can see it grow, for example, almost 4,000% in like what in 17 years. But it's still going to continue to grow. But not just that. If we can take you cannot just trade the company itself. You can also trade the index. Like for example, in this case, you can take the NDX, like for example, and you can see the same happen, the same stuff. So yeah, we had here the bubble dot crash, of the websites and so on. But after that, you can see it started again. Why? Because most of the companies that are inside, the index itself, they started to grow as well. And then let's take for example the SPX, which is I would say the most important one of them all. You can see that since its beginning, it was always in a continuous growth, so and it will continue to grow. Why? Because as long as they are going to be made more and more money. At the same time, those prices are going to evolve as well. And yeah, so if you think about it, like as an investment tool, if you are going to buy now and you're going to forget for like 10, 20 years, 30 years, you will have no issue. You will have much bigger revenue that you just simply by like it in a bank or something like that. So I would say it's one of the most safest, I would say, passive investment styles. Like buy an index like the XP or the Nasdaq or the US 30. However, I believe most of you which are here, I want to teach you, and give you the tools to make more, even a better, I would say, approach. Even if you want to be in investment, to increase that capital and learn how to make use of the compound effect, but at the same time give you the tools, for the trading itself. So yeah, what else do we have here? The price, the evolution. Yeah, like I said, I'm going to give you both the technical analysis and the fundamental analysis. For the fundamentals, I would say the most important, of course, are going to be the new monetary policies, changes in the interest, inflation, deflation, kind of in general, the macroeconomic stuff, these are the most important ones. And yeah, you have psychological factors as well, like for example, it happened last year with the corona. So yeah, I believe this is kind of give a good description, of the stock market. And see you in the next video, which is going to be commodities. Thank you for watching.